In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analysts' predictions are, create a valuation, and review then rate the company. Today we are going to look at Adobe, ticker ADBE. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics achieve or exceed a specific target. Companies can earn 1 point for fully meeting the target or 0.5 points for coming within 2% below the target. The first pillar is earnings per share growth. This is where we take the net income and divide it by the shares outstanding. For Adobe, earnings per share growth over the past 12 months is 23%, exceeding the 10% target, scoring 1 point. Next, let's look at free cash flow growth, which measures the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health and prefers companies that can generate substantial free cash flow. Adobe's free cash flow growth is 18%, exceeding the 10% target, scoring 1 point. Next, we come to revenue growth, which tells us how good the company is at generating income before deducting expenses. Adobe's revenue growth is 3%, below the 10% target, scoring 0 points. Now let's turn to book value growth, calculated by subtracting total liabilities from total assets to indicate equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. Adobe's book value growth is -6%, which is negative, scoring 0 points. We then assess the management of the business by looking at return on invested capital and return on equity. These measures allow us to evaluate a company's efficiency at allocating capital. For Adobe, return on invested capital is 34%, and return on equity is 52%, both far exceeding the 10% target, scoring 1 point for each. Now we move on to debt. Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow within 3 years. Adobe's debt would take 0.71 years to pay off, which is well below the target and earns 1 point. With the information we have gathered, it tells us that aspects of the key pillars are solid, but let's explore the company further. Now let's look at the remaining key pillars which help define an excellent business. Let's look at the gross margin, which indicates how much money a company retains after incurring the direct costs of producing its goods or services. This is currently at 89%, exceeding the 40% target, scoring 1 point. Next, we come to the operating profit margin, which tells us how much profit a company makes on $1 of sales after production costs but before interest or tax. Peter Lynch prefers companies with strong operating margins when assessing their financial health and competitive advantage. Adobe's operating profit margin is 37%, far exceeding the target, scoring 1 point. Free cash flow yield provides a more realistic view of a business's financial health. Terry Smith prefers companies with a free cash flow yield of 5% or higher. Adobe's free cash flow yield is 5.33%, exceeding the target, scoring 1 point. Next, we assess the 10-year book value growth as potential shareholders. For Adobe, this is 2%, which is below the 10% target, scoring 0 points. Lastly, Bill Miller believes earnings growth is the biggest indicator of a company's stock price. Adobe's 5-year net income growth is 6%, which is also below the 10% target, scoring 0 points. In the description, I've included a link to the investors page and the annual report if you want to check it out for yourself. Adobe has demonstrated strong financial performance across several metrics, including high margins, excellent return on capital, and strong free cash flow. However, lower revenue growth and negative book value growth are areas that investors may want to monitor. As of today, the stock is trading at $387.26. Over the past year, the stock has traded sideways with periods of volatility influenced by market-wide tech sentiment and acquisition announcements. Looking at the overview, we can see the current market cap is approximately $168.42 billion. They are currently generating $22 billion in revenue for the trailing 12 months and have 434.90 million shares outstanding. At present, their earnings per share tell us that for each share of stock, the company is generating $15.16. Their price-to-earnings ratio is 25.54, which is about the same as the S&P 500. According to Morningstar, Adobe has a wide economic moat, due to its dominant position in digital content creation and subscription-based software. The overall consensus among analysts is a buy, with a 12-month price target of approximately $550. Analysts are forecasting an average EPS growth rate of 23% over the next 5 years. Let's calculate a valuation. I will use Adobe's current earnings per share of $15.16. Combining historical growth rates and future analyst predictions, I estimate an earnings per share growth of 10%. Assigning a forward price to earnings ratio of 28, projecting 10 years forward, and applying a desired return rate of 10%. This results in a future stock price of about $1,101. The current intrinsic value is about $424, with a margin of safety at $318. Since the current price of $387 is below the intrinsic value, this scores a check. But it depends on how much margin of safety you want to apply, and what your outlook for the company is, as well as the return on the investment you would like to see. When reviewing the key pillars, Adobe scored 8 out of 12, earning a check. Over the last year, the stock, like the stock market, has experienced volatility, but this could present a buying opportunity as the fundamentals still look good. This score a check. Analysts are predicting a growth rate of 23%, scoring a check. The current price matches the intrinsic value, signaling a check. According to Morningstar, Adobe has a wide economic moat, which scores a check. My final overall rating is 5 out of 5 stars. Adobe continues to demonstrate strong fundamentals, but areas like revenue and book value growth should be monitored by long-term investors. Thank you for joining me in today's analysis. Don't forget to like and subscribe for more insights.